YouTube subscribers, investors, welcome to the Investor Channel. Time to talk about the PE ratio, otherwise known as the price to earnings ratio. This is how we calculate it. We've got share price, which is the price for the share, whether it be $30 or $100 or $5. And this is over divided by earnings per share. So we're taking earnings, so whether it's $1 million or $1 billion, and that's per share. So you're actually dividing this number by the number of shares. So every company sometimes has millions or hundreds of millions, maybe even billions of shares outstanding out there that people can buy and sell on a daily basis. So you find earnings per share, otherwise known as EPS. And that equals the price to earnings ratio, or essentially for every dollar you're paying for a share price, you're getting X amount in earnings. So let's take a look at this in a real context, because I think that's really what you want to watch from this video. Anybody can show you this formula, and with a little bit of practice, you could figure out. But what the heck, Matt? What the heck does it mean to have a high P ratio or a low P ratio? Should you only buy low P ratio companies? Should you only buy companies with high P ratio companies? So we'll answer that question, kind of going through real context, real companies here. So let's first look at Amazon. And if you follow the investor community at all, you realize that Amazon has always been a quote unquote high PE stock, otherwise known as a company that you're paying a lot for their earnings, sometimes non-existent earnings. It wasn't until recently that Amazon even had a PE ratio. Now, I told you that you didn't have to bust out your calculator every time to find the PE ratio. That's because on a lot of investor sites, they're showing you the number here. And this is Seeking Alpha. You can go to E-Trade or Yahoo Finance or Morningstar. Just about any of these sites will have the PE. Now, one thing you might take note of is this is FWD, and you can imagine that likely means forward. And that's exactly what it means. We also have EPS forward up here. What this is analyst estimates of what the EPS. So first we've got the EPS. We've got analyst estimates are that Amazon will earn $19.91 next year, earnings per share. And they will and that will extrapolate out to a forward PE based on today's stock price of 85. Okay, Amazon used to be a lot higher than this. They used to not even have a PE ratio. They used to lose money for a decade. Actually, they've lost money. Well, until recently, Amazon has started to earn money, and this PE ratio has 85 is still high, and I'll show you in a little bit why this is considered high compared to other companies. But first of all, let's look at this 5-year chart. Let's take a step back. Okay, here's a 5-year chart of Amazon right here. Okay, back in January of 2014, shares were at $400. Look where they are at today, $1,600. Okay, so this is back when Amazon didn't make any money. So clearly, people will bid up stocks even when there's no PE or it's an astronomically high PE. So first myth that we're going to debunk today, that avoiding high PE stocks is likely not a great investment idea. Okay, because here's one of the best performing stocks over the last decade, maybe even over the last 20 years, Amazon. And if you avoided it because it had a high PE ratio, that's a problem, because you just missed a fortune of money making opportunities here just over the last 5 years. We could spread this out to 10 years. We can spread this out to the max, and you can see, oh, look at Amazon back in 2002, $11 a share. I bet their PE ratio is pretty high back then. Okay. Do you want to load your if you have a $10,000 portfolio, do you want $9,000 of that being in high PE, high risk companies? Maybe, maybe not. If you're 65, 70 years old, absolutely not. If you're 13, 14, 15 years old, just starting out investing, I don't know. Might be a good idea to buy companies, that are going to go from $14 to $1,600 a share over, the course of your young youth. Let's contrast this with AT&T. Another long, great company, another company I have in my portfolio. Look at the PE ratio here, 8. Okay, much lower. Okay, again, Amazon, 80 PE. Okay, look at the stock chart. Unbelievable. Okay, look at this PE, 8. Look at the 10-year chart. In 2009, AT&T was worth $27. What is it worth today? 30. Now, you have collected, kind of going off topic here, you have collected a dividend for AT&T. I don't think that's included in this price to earnings ratio. In fact, we know it's not. But the one point I did want to make is this is forward. So these are analyst estimates. So we're looking forward. This is the price to earnings ratio if AT&T makes $3.49 per share next year. This is the price, and this is based on today's price. There's also something called TTM EPS, which is trailing 12 months. So if you're in December, it's basically looking back throughout the last 12 months of EPS and price to earnings ratio calculated off that. You might wonder, okay, what's the difference? Should I use trailing 12 months or should I look forward and look for forward estimates? For me, it depends on how accurate you think these analysts are going to be. If you think these analysts are accurate, AT&T's not going to have too many bumps in the road, maybe in Washington with the president, or getting sued, or running into debt problems, whatever problems you think AT&T might have. If you think, well, I think it's going to be a year that's going to be easily predictable, these high-priced analysts are going to be able to accurately, within a certain degree of, accuracy here, predict EPS and then predict the forward earnings per share. Then maybe maybe you can look forward. Trailing 12 months, I would say, again, you're looking backwards, and is AT&T going to perform the same over the next 12 months or maybe 24 months or 2-3 years as they have the last 12 months? It's hard to say. I typically look for this forward number because I kind of want to see where the street and kind of analysts are predicting where these companies will be over the next 12 months or so, and kind of guide my investing practice through this. But that's just to give you an idea. When you see there's two different types of PE, which one you should choose, I think it depends on the situation you're trying to analyze. Are you trying to analyze historically, is Amazon an expensive stock right now? Well, then you might look backwards at trailing 12 months. Are you looking, say, comparing Amazon's next 12 months to, say, Apple's next 12 months? You might say, well, Amazon's forward PE is 85, Apple's forward PE is 13. And so you might do comparisons that way as well. So here we are on Apple. Again, one of the largest companies in the world. We'll look at their 10-year chart. Pretty incredible to believe, but I think this is split adjusted. Shares were at $31.30 back in 2010, $30, Apple stock. Okay, this is after the iPhone has come out. Okay, Apple iPhone, I think, was released sometime in 2008, if I recall, or maybe even 2007. I can't remember exactly. But here we go. Few years in, this is probably Apple, iPhone 3 is out. $30 a share. What are we at today? $168. I will say that for the most part, Apple's PE and forward PE has remained in this range, in part because they have a fairly diverse business. And even they have, growing iPhone sales. Those are device sales. Whereas Amazon, far different company, and is playing in a couple more different sandboxes than even Apple is. Now, on to an example of a company that has an enormous PE, but as we see the stock chart, this company, when it first IPO'd, was actually up in the $8, $9, $10 a share range. Shares cratered into this $2 range, but they've performed nicely over the last year or so, very nicely. One of the probably better performing stocks in your portfolio if you had this. If you'd bought it back here in this $2 to $3 range, shares are up here in the $7 to $8 range. Forward EPS is 0. might be 0.001. I think this company is guiding to some kind of positive EPS for next year. Don't quote me on that. But we see this forward PE is 3,000. And so if you have a hard and fast rule, I'm never going to invest in a company with high, quote unquote, high PE. Well, you would have missed, what is this, a 2, 3, 400% move here. Same with Amazon. Would have missed astronomical move. And if you said, I'm going to only invest in safe companies like AT&T, well, your share price wouldn't have done much. You would have earned about, between 5 and 6% a year on your investment. So I'm definitely not. And then if you reinvest that into shares and start compounding that, I'm not saying this has no business in your portfolio. It certainly does. It's in my portfolio. It's in multiple portfolios. But there's a lot of investors I see, on sites like Seeking Alpha. There's quite a discussion on a lot of these stocks. As you see, you roll through here. There's comments on all these articles. A lot of the comments, around companies like Amazon is, the PE is so high, it has to come down. Well, guys, people have been saying that for 2 decades. And as we saw here, share price can go up, but if your earnings go up and or you reduce your share count, which a lot of companies are doing through buybacks, well, then your PE ratio will go down. And in the case of Amazon, the share price has gone up. I guarantee you the share count has gone up as well. But what's gone up is earnings, because the business is starting to mature. They don't have to build out fulfillment centers. AT&T, lot different kind of business. How mature is the wireline, internet, cell phone business? I know it's not a business that's been around for forever. And I know AT&T is trying to buy Time Warner. I'm not sure if that's finalized yet. They own DirecTV and a couple other assets. So they're kind of in the entertainment media kind of business. But as we've seen, stock flat, PE low, PE high. What does that mean here? So let's just compare and contrast AT&T. AT&T, like I just said, steady business. Okay? They used to dominate kind of the landline, the corded phone. Okay, that phased out. They replaced those revenues, probably exponentially, with cell phone subscription, internet, Wi-Fi type subscriptions, and then eventually TV, satellite TV, and now they're into the content. They own HBO, CNN, those types of companies as well. But again, they've bought companies, TV, media, advertising. Those are also very old legacy businesses. People are not paying huge amount of money for every dollar that AT&T is bringing in. Amazon, quite the opposite. Okay, this PE used to be a lot higher. But as we've seen, the share price was also a lot lower at that time. Amazon, what businesses they play in? E-commerce. Still growing exponentially year over year. You don't have to know much about e-commerce to know it's growing. They're in streaming. They're in cloud computing. The leader in cloud computing. This is a company that is investing. They're in artificial intelligence. They're investing in some of the fastest and newest and kind of sexiest investment ideas, and they're a market leader in a lot of them. So it gets investors excited, gets their attention. What investors are expecting is this number, earnings, to grow. Okay? This number starts growing, it often takes care of everything else. Investors with AT&T not expecting big earnings jumps. Yes, consistently year over year, is AT&T churning out a little bit more money, Yes, they are. But they're not in cloud computing. They're not in these fast-growing, hyper-growth businesses like Amazon is. Apple's kind of the same way as AT&T. This is why Apple forward PE is 13. Relatively modest, as we'll find here in a minute. That's because while they dominate the cell phone space, it has gotten a little saturated. And a lot of people are wondering what's next for Apple. They've got a lot of cash. And that's where this price to earnings ratio, little bit different from, in my opinion, for a company like Apple. Just knowing what I know, and this is why, as I go through this video, I want you to understand. Well, we're going to debunk a myth number 2 here. Myth number 2 is don't just invest on PE ratio alone, okay? Because with a company like Apple, you might say, wow, 13 ratio, investors aren't really excited about the earnings. They're not paying, as much as Amazon, or we could pull up Netflix or Tesla or any of these kind of high-flying companies here that have astronomical PEs. Apple is right in the middle of the pack, or maybe even below. But we know it's one of the world's richest companies, okay? They have a ton of cash. Okay, this PE ratio doesn't really factor in the balance sheet. Apple could buy most of these other companies almost outright with cash, not necessarily Amazon, but maybe AT&T, $200 billion. I think that's about what they have. They might even have more than that. Okay, let alone some of these micro-cap companies, 100 million. Apple could buy a lot of companies just outright with cash. They could buy some really fast-growing companies. They could buy Netflix. They could buy Disney. They could buy, a lot of different companies. They could buy Nike. It doesn't really matter. But they could turn this PE ratio on its head. That's why you can't necessarily just say, oh, Apple's PE ratio is low. It has no business in my portfolio. Just the same as saying, oh, Amazon's PE ratio is high. It has no business in my portfolio. That's not what an investor does. They don't just look at one number and make a decision. Okay, it should play a factor into your overall investing goals. Okay, if you have a portfolio, there's absolutely room for companies like AT&T that pay a 6% dividend at 8 times earnings. You're getting 6% on your money and you're not paying a whole lot for it. Okay, that's what AT&T represents. Do you want it to be 100% of your portfolio? Do you want it to be the bulk of your portfolio? To me, that depends on your risk tolerance and your age. Apple, 13 times earning. Well, getting just keeping up with inflation here, a 1.6% yield forward. Should this be the bulk of your portfolio? Obviously, if it has been over the last 10 years, you're probably sitting pretty nice. Okay, you're probably glad about that decision. But I mean, as many stocks have gone like this, a lot of them gone the other way as well. But this absolutely has room in your portfolio. Does Amazon at 85 times forward earnings and no dividend? Does this have a role in your portfolio? And a stock that's up thousands of percent over the last 10 years? Does this have room in your portfolio? For sure. Does it have room to be the number one holding in your portfolio? That's something you probably want to judge your risk level again very carefully, depending on your age and how much you're willing to risk whatever money you have in here. Okay, obviously it's $1,600 a share. You start getting 5, 6, 7 shares of this company, and for most people, that's a big, big, big chunk of their portfolio. Okay, so you have to weigh all. Now I'm starting to give you kind of idea what the things you've got to weigh, not just PE, but what percentage will this be in your portfolio? If you've got a $10,000 portfolio and you buy one share of Amazon, well, it's already 16% of your portfolio. So there's 16% wrapped up in a pretty high PE company. You might think about balancing that with some more relatively priced companies in terms of earnings. I think that'd be a prudent thing to do. And then you've got micro cap companies, which you've got to be selective on when you buy them. But as you can see, you selectively buy, relatively strong micro cap companies, and they can perform very well for you. Now, what I want to do is this is something else I really like to do with PE ratio, is, okay, here's a snapshot. This is forward P. This is snapshot over the next 12 months. Trailing 12 months PE ratio, we don't have that necessarily here. It could be that you can come to some of these other parts on here on Seeking Alpha or Morningstar and might be able to find trailing 12 months. This is a snapshot in time, just over the last couple months. What I sometimes often do is there's a couple different sites that do this. And this is a site called Macro Trends. I don't have anything to do with this website, just that their data is free and it's useful. This is what I want to show you, and I find this to be incredibly valuable. Here is a historical look. This is Nike. So we're looking at Nike PE ratio from basically the last 12 years. This is showing you, what do investors pay for Nike year after year after year? You see here, and I'm gonna tell you, this is a real life example for me. I started buying Nike, let's see, it was somewhere in here, I think. I really like Nike when the price to earnings is around 20, preferably less than 20. To me, as you can see, Nike has a long track record of growing this EPS. Now it's taken a dip here. Could be for a number of reasons. Maybe they've increased their share count, or maybe just EPS is down a little bit. But as we can see, the price earning ratio has jumped accordingly because this number has dipped, and this number, as we can see, has risen considerably. Now the price earnings is 60. We see how out of whack this is to the rest of this. Now, am I predicting Nike stock to decline? We've seen it's actually declined a little bit here over the last, I'd say the last 6 months or so. Am I predicting this keeps going down? Not necessarily. But would I be a buyer of Nike when we've seen, look at this track record of this price earnings ratio, especially it's a really strong trend when you're looking here from 2012 or so all the way for 5 years. This stock traded in a pretty tight range for price earnings ratio, and then it just popped for no super really good reason, okay, other than the outlook does remain strong for Nike. Okay, would I sell Nike short up here? Would I sell all my shares? I don't know. Again, that depends on how old you are, what's your risk tolerance level, what you're going to use the money for, things like that. Okay, I don't have any use for my Nike share money, and it does produce a dividend, so I'm just going to hold it through this period. But am I going to acquire shares up here? No, probably not. We're paying 60 times earnings up here, okay? For the last 10 years, I could have got it numerous times under 20 times earnings. And look at this. We've got EPS growing. Look at the share price growing. So this is really, for me, this is something I really use. I don't just like to look at PE ratio and say, oh, that's too high. Oh, that's too low. Oh, that's just right, okay? No, what I like to do is say, hey, what is it for this company over a long period of time? Okay, and this is a really, really fun thing to do. Really what I like to do, and probably a lot of you people listening out there, is if you're trading stocks, who cares about the PE ratio? Okay, you're really going on supply and demand. Who cares about all the ratios and all this other stuff? There's a lot of other charts you should be looking at than PE ratio. So if you're trying to learn what PE ratio is, and I probably imagine most of you guys are doing that since you're watching this video, what you're probably trying to do is saying, is this stock worth buying? Okay, here's how one of the ways I decide is by looking at the history of the P ratio. And like right now, do I want to buy more Nike shares? Of course. I think it's a great company. I think this EPS is going to keep tracking upwards. I think they have some of the best marketing ever. I mean, that Colin Kaepernick ad, whether you agree with he should kneel or not, I don't care. Everybody knows what ad I am talking about right now. How many other companies can you think of off the top of your head that have ads that you can just remember right off the top of your head? Nike is one of them, and they do it year after year, time after time, with different athletes, different situations. And so I love this company. But am I going to pay 60 times earnings when for the last 10 years you could pay under 20 times, numerous times? No, I'm not. So this is a great, great way to find an entry price. I think that was my main point here is, should I buy shares at 30 or should I wait till it comes down a little bit? Here's one indication of where you could see, should I've even had people email me and get at me on Twitter. Should I buy Nike now? Because a lot of people know I really like this stock. And I keep telling them, I think it's a great company, but I think you should wait. Share price is high. I don't really care what the share price could be 7,000. If it's worth it to me to buy it, I'll come up with the money and I'll buy a share. But it's really this earnings per share. I've got to pay 50, 60 times when just a couple years ago I could pay 3 times less. So just don't think it. Now, if the trend is going to be up here in 60 times, then maybe we'll have to pony up some money here. But I'll just keep holding these shares and the dividend will keep reinvesting. Here's another thing you can use. This site is called FinViz. Again, no affiliation. This is going to show you each sector, kind of the main sector. So financial, consumer good, basic materials, utilities, and on down. And it's giving you kind of a forward PE and kind of, I'm assuming this is trailing 12 months PE. And it's giving you an idea in the sector. So let's just take this bank, for example, the financials. And maybe, Bank of America and Wells Fargo and these kind of mainstream banks probably trade pretty darn close to this forward P. Well, maybe you've got a different kind of financial like Lending Club or PayPal or, Visa or MasterCard or some of these kind of almost like a hybrid financial company. And maybe their P is a lot higher. That can give you, some insight one way or another. Again, I'm not saying, I guarantee you PayPal's PE and Visa's PE are a lot higher than that. Those are 2 companies I own. Okay, I didn't look at their PE ratio when I bought the companies. Okay, but this can kind of give you a general idea. Look at technology, 17 times. Where's Apple? 13 times. Okay, I'll let you decide if Apple is better than 17 times. Look at the 20 times here. Okay. But you'll see, basic materials 11 times. This is kind of probably your steel makers, your, your lumber guys. I mean, you probably click on it and there you go. Yeah, Alcoa, companies like that. So this gives you an idea on kind of general PE ratios, where they are in terms of kind of average. So you can kind of see, okay, here's a conglomerate, 45. I don't know if you could call Amazon a conglomerate in the technical term, but they do have lots of different businesses kind of all going at one time. Not all of them are related that much, okay? I mean, I know cloud computing helps their site, but, when somebody's buying their toilet paper on Amazon, are they really thinking about cloud computing? Probably not. When somebody's streaming puppy dog pals on Amazon Prime Video, are they really worried about some of the, the fulfillment centers and the robots and kind of the artificial intelligence going on behind the scenes at Amazon? No. But there's a lot of other investors that are. And so you see the market in general is actually willing to pay up more for these conglomerates. I don't recognize a lot of these guys off the top of my head. Some of this could be some bad data, but in general, this gives you an idea. Well, kind of a quick snapshot. Most people are willing to pay between 11 and 18 times earnings for relatively profitable companies. And so sometimes what I like, sometimes you're like, I want to buy Apple stock, and you kind of need that thing to push you over the edge. This could push you over the edge. You could say, hey, well, the technology sector, investors are willing to pay 17 times earnings for all these companies here. Okay? Well, here's probably the best of breed, and I'm only paying 13 times. Well, that seems like a good deal. I'm going to buy a couple shares. So that's the thought process I'd like to see all of you kind of go through. when you're looking at price to earnings ratio. Don't just say, oh, that's high PE ratio, I'm done with it. That's low PE ratio, I'm going to load up. Okay, that is like kindergarten analysis. If you want to be a great investor, one that performs year after year, time after time, you got to go a little bit deeper than this. And I showed you a little bit on how you can do that. You can look at kind of historical trends of this PE. Where's this PE been over the last 10 years? Where is it now? What is this PE in relation to other companies, other markets? You can also do a one-on-one comparison. So you can take Apple and pin it against Microsoft. I don't know if that's a great comparison. Or you can take Amazon and compare it to Microsoft. You can take, probably a better thing is take AT&T and compare it to Verizon. Almost identical companies. Okay, I know that AT&T's diversified a little bit into some other areas, but Verizon's right there too. Look what you're paying here. 4 times and you're earning 4.5%. Look at AT&T. 8 times, 6.5%. Now, that right there should, for most investors, bring up a kindergarten analysis would be, I want to invest in Verizon or AT&T. Well, Verizon is 12 times and a 4% yield, and AT&T's 8 times and 6% yield, so better yield, cheaper earnings per share. I'm going to buy AT&T. That's kindergarten analysis. Because the market is telling you, I'm willing to pay, and by I mean the market is willing to pay more for a company, more for this company's earnings, which are almost identical to this one's, and the yield is less. So I'm going to earn 4% on my money versus 6. Okay, you're going to double your money almost every 11 years here? X inflation out here, and you're at 2%. Okay, not a very impressive, it's going to take a while for you to just double your money on yield. But why are investors willing to pay more here for a company that yields less when here's a company that's almost identical, willing to pay 8 times and 6? I'll tell you just off the top of my head, both these companies have a lot of debt. AT&T in particular has a lot of debt. Lot of debt. Okay, Verizon does too. So that's something you want to dig into. Don't just say, "Oh, well, shoot, AT&T's cheaper and it yields higher. I'm gonna buy AT&T." That's some kindergarten analysis. You really need to also look at how Amazon or Verizon stock has performed, okay, versus AT&T's. AT&T's been, we've had some peaks and valleys here, but it's about the same. Verizon has steadily churned up, okay. Better idea, I think, is owning them both. Okay, I actually own both these companies. Not trying to give you investing advice here, but this isn't a football game. That's probably my last advice here before we wrap this video game up. Investing is not rooting for a football team or a basketball team. Okay, it's not AT&T versus Verizon. Don't let your personal, and I often see this with like Amazon and Apple. People that are Android users hate Apple and won't invest in it. People that don't like shopping on Amazon won't buy the shares. Or they had a bad experience buying on Amazon.com and then they won't buy the shares. Guys, this isn't a football game. This isn't rooting for the LA Lakers or the LA Clippers or the San Francisco Giants and the LA Dodgers. This isn't sports, okay? It's okay to own a little bit of AT&T, a little bit of Verizon. It's okay to own a little bit of Amazon and a little bit of Microsoft. It's okay to own a little bit of Apple and a little bit of Samsung. It's okay to own a little bit of Chevron and a little bit of ConocoPhillips. It's okay to own Wells Fargo and Bank of America and Goldman Sachs and Morgan Stanley and whoever else you want to invest in. It's not a football game. It's not a competition. Okay, do these companies compete? Absolutely. But can they both win? Absolutely. Of course. We've seen it. Max. Okay. How long has this company been around? A long time. How long has this company been around? A really, really long time. This isn't even going back far enough, I don't think. Okay, both companies can win. Okay, it's not a football game. Okay, can you invest in Nike and Adidas? Of course you can. Do they compete? Of course they do. But can they both win? Of course they can. So investors, hopefully you learned a little bit of something here. We got PE ratio, we've got forward PE ratio, we got trailing 12 months, we've got earnings per share here, we've got share price. But more importantly, we got to remember this is one tool in our toolbox. Have you ever met a carpenter with one hammer and one saw? Have you ever met a dentist with one drill or one little tool that he uses to clean your teeth? I'd probably be a little scared about that. Have you ever met a race car driver that only knows how to drive one car? No. Okay. This is one tool in our toolbox among many. And we've got to take it within context, not only the company, but the sector that we're investing in. We've got to take it in context with historical, based on not only that company, but also within the sector itself and kind of the market dynamics we're in. And also, it should lead to further investigation. As I showed you with the AT&T and Verizon example, we're paying 12 times at a 4% yield. We're paying 8 times at a 6% yield. Why is that? Okay, these are two of the most followed stocks in the world. Millions and millions of shares of these companies trade on a daily basis. Okay, it's not that the market is getting it tremendously wrong. Okay, it's that investors are willing to pay more for Verizon's earnings than AT&T's. And if you dig into the companies, you'll likely realize why. And then finally, this is not rooting for your favorite football team. This is not like a competition between these two companies inside your own portfolio. They both can perform relatively well inside your portfolio if you give them the opportunity to do that and if you find fit. So hopefully you enjoyed this video. Click subscribe, leave me a comment, leave me a question. I'll come back with another video soon, but good luck with your investing opportunities out there. We'll see you later.